Getting a mortgage when you're a business owner is really hard, right? Well, no. It's true that it's not as straightforward as when you're a salaried employee. There are different things to think about, organise and prepare, but it is 100% possible. So if you're a business owner, here's 5 things that you need to know to make moving into that dream house a reality. Hi, I'm Claire, money coach and qualified financial advisor. For the last 14 years, I've been working in the financial services sector and I run a successful financial services business. I'm here to help you walk into wealth, enriched, empowered and excited. I've built my dream life and now I'm going to help you build yours. And remember, if you have any questions, post them below because at the end of each video, I answer one viewer's question and next time it could be yours. Okay, let's get on with today's show. Getting into your dream home is something that many of us aspire to. It gives us more security than renting and an asset that over time should increase in value, while giving us somewhere amazing to live in the meantime. But unless you've amassed a whole load of savings and buy your property outright for cash, you're likely to need to borrow the rest of the money you need on a mortgage, which is where things sometimes become a little bit more tricky. Why? Well, you need the right paperwork to back up your income, both through your business and any income you have coming in from anywhere else. But sometimes the paperwork you have may not accurately reflect the money flowing through your business. Your business may have only been trading for a couple of years or may have dramatically grown over the last few months, meaning that last year's tax returns may not be an accurate representation of where your business is now. It's only fair that lenders need to work out how much they can safely afford to lend you, and you need to show them that you can afford to repay the money that you've had. But lenders will look at the salary and dividends you take from the business and base what they will lend you on this. Some lenders also look at your net profit, your bottom line after all your operating costs, expenses and tax, to see if you have money in the business that you could have taken out but have chosen not to, and they'll let you use this as well. But either way, you should be looking to show a healthy positive figure which is constant or increasing year on year. But if you want to stand the best chances of being accepted first time for that mortgage you want, what should you do? Here are my 5 top tips based on placing hundreds of mortgages over the last 14 years. So number 1, keep accurate accounts. I know this sounds obvious, but this means putting all of your income through the books. However tempting cash in hand might feel, A, it's illegal, and B, if it's not showing in your books, you can't use the income when you come to get a mortgage. It's worth knowing that different lenders will ask you to prove your income in different ways. Some lenders will use the figures from your finalised accounts, but many will use your SA 302, which is a tax return form issued by HMRC, and other lenders still will write out to your accountant and ask for a reference direct from them. So if your year end in your business is not April, the figures on these could be very different and impact the amount that you're able to borrow. So you need a lender that's going to use the paperwork which will present your case in the best possible light. Okay, so you know that I live in the countryside with alpacas in my garden, but I'd love to know what your dream home looks like. Maybe it's a house in the country or a luxury city apartment. I'd love to know, so please tell me in the comments below where you'd really like to live. Right, so moving on to tip number 2. Tell your accountant that you're looking to get a mortgage. They're not psychic, and some of the expenses that your accountant can claim are discretionary. And by claiming fewer of them or deferring them to another year, it boosts your profit and then your borrowing capacity. So fill your accountant in on your plans and they can work with you to find the right balance. And if you're looking to make a big business investment into training or new equipment, waiting until your next trading year will mean that you show a higher profit this year and might be able to borrow more money. Tip number 3, start planning before you're ready. Even if you don't think you'll want a mortgage for another couple of years, now is the time to start planning for it. When they look at your income for a mortgage, some lenders will base it on your figures from the last year if your credit score is good enough, which can be great if your income was much higher than it had been in previous years. But many other lenders average the money that they take as your income, which they do by adding up your profit over the last 2 or 3 years. So it might be you need to look to increase the profit in your business over a couple of years so as to be able to borrow the money you need to buy the home you really want, rather than the "it's okay for now" house. Getting the paperwork in order now can make all the difference when the time comes, rather than waiting until you're ready to apply for a mortgage and wishing that you'd started all this 3 years ago. Tip 4. Use a good whole-of-market mortgage advisor. There are so many mortgages out there, it can be confusing to know where to start. And it's so easy to waste time, money and energy applying to lenders who are unlikely to ever accept your case. A good whole-of-market advisor will know which lender to use to present your case in the best light, based on your specific personal circumstances. Plus, they'll hold your hand through the process, organise solicitors, surveys and all the protection that you need to ensure that your home is safe if anything happens to your income. It might seem like another expense to add to the list of home moving costs, but they'll more than earn the money that you invest in their services. The thing to remember is that the mortgage with the cheapest interest rate is not necessarily going to be the most appropriate mortgage for your needs, if they won't actually lend you enough money to buy the home you've fallen in love with. Depending on which paperwork you have, your credit score and the amount you need to borrow, a lender will be selected that is likely to accept your application first time, without causing unnecessarily delays or headaches. Almost there. Keep watching for my last tip to get a mortgage as a business owner. But first, if you're still with me, can you take a couple of seconds just to hit the subscribe button and give this video a thumbs up or leave a comment underneath? It really helps keep me motivated to bring you even more helpful content. Let's go. Number 5, time to look at your savings and your debt. A few years ago, the affordability rules changed around mortgages, which means that the lender is now responsible for deciding how much you can borrow, depending on rules and metrics that they put in place themselves. And they each do this in their own way, which means the amount you borrow can vary massively from lender to lender. I've seen one lender offer £170,000 and another £260,000 on the same data. But on average, it tends to be around 4 to 5 times your income. So if you want to mortgage a £200,000, you're going to need a net profit of around £50,000 a year. Lenders will take off car payments and other finance deductions you have, and if you've got balances on credit cards, they'll take off some money for these too. So this is where paying them off before you move can really pay off, because it will enable you to borrow more money, which could be the difference between buying the house you love and another house altogether. When you move house, your deposit will come from the equity in your current home and any savings you have. The more savings you have, the better, as you'll get a better choice of lenders and a lower interest rate on your overall borrowing. So if your business has done really well since your last set of accounts, try to tuck away any extra money you have to increase the size of your deposit. And of course, you'll also need money for stamp duty, solicitors' fees, valuations and other moving costs. So don't forget things like a removal company, so that you don't end up trying to stuff all your stuff in a van with your best friend and end up falling out over it. It's just not worth the effort. The earlier you can start putting money away for your dream home to cover these things too, the better. As a whole-of-market mortgage advisor, I've successfully placed mortgages for business owners for 14 years now, and I love it best when clients send me a selfie in front of their new home. So let's help you have a stress-free journey into your dream home too. So it's now time for today's Ask Claire money question, and it comes from Sarah, who asks, if I've only started my business a year ago, can I still get a mortgage? Lots of people say you need 3 years accounts. Well, the answer is yes. You'll need at least 1 complete year's accounts, but some lenders will do it. The thing to bear in mind is that you'll get a much better choice of lenders the more paperwork you have. The exception to this is for contractors. So if despite being self-employed you get paid a fixed day rate from a company on a contract, sometimes we can place this with a single contract even if you only signed it a few months ago. But the key thing is to get an advisor to choose a lender that will work, rather than damaging your credit score by applying to a lender who later turns you down. I hope this has helped you take one step closer to that life you really want. So keep watching.